When we hear about property investments, most of us will think about residential property, as this is the one that is most familiar to us. I mean, we all need to live somewhere, right? But there's actually so much more to property investments, and if you have just a little extra cash that you want to invest towards property, then you found the right video, as I'll go over exactly what types of property investments there are available, what the pros and cons that you need to consider for each type are, as well as how exactly you can get started in South Africa. Now, when we speak about property investments, there are basically two different ways that you can go about it. You can either buy your own physical property to either live in yourself or to rent out for an income, or you can buy shares in a large company that owns a bunch of other physical properties by means of listed property exchange traded funds or ETFs, or real estate investment trusts or REITs. Now, needless to say, each one of these strategies comes with its own pros and cons, so let's have a look. So when it comes to residential property, you will basically get two different types of people. Those who swear by it and those who swear at it. There are definitely people out there who are millionaires, if not billionaires, by finding good deals and building a massive portfolio of residential properties over their lifetimes. And they are probably in a very nice position to be able to live off of the rental income that they receive without having to do much. That is, if they hired a manager. But right off the bat, I do need to stress that if you really want to be successful in this industry, you will need to know what you are doing. In order to come out on the top, you will at least need to beat the average. And the average consists of very large corporate companies that hire very smart and very experienced real estate agents to spot and secure the best deals that are available. These guys have done it for many years. They know how the game works. So if you want to go this route, then by all means go for it. But just make sure that you do your homework properly. But just make sure that you do your homework properly and that you realize what you are against. Okay, so with residential property investments, you basically get three main strategies. The first one is buy to let, and this is where you buy a property to rent it out to tenants with the idea that the rent that you will receive will cover your bond and other property expenses. The second one is buy and flip. This is where you buy a property, you renovate it to increase its value, and then sell it afterwards for a profit. And then the third one is repurposing. With this one, you buy a house and then renovate it into a commune or separate flats to be then rented out or sold. Now, let's look at some of the pros of residential property investments. An investment property can very well become a cash generating machine, especially if you manage to line up several different properties. Investing in property gives you access to gearing, which essentially means you can use borrowed money from the bank to basically turbocharge your investments. The interest portion of a home loan on an investment property is tax deductible, which means you can write off any interest expense against tax. And once you start making a profit on your property, you can just rebond it, meaning you once again won't have to pay any tax on it, and you can gain access to more cash to buy even more investment properties. And by repeating this process a couple of times, this will allow you to build up your property portfolio pretty quickly to become richy rich. Property is also a physical asset and not a paper asset, which means it is a bit more stable than shares or equity and has a lower chance of losing a lot of its value, such as what happens with shares during a market crash. And lastly, you can leverage property, which means you can rent it out to someone who can then pay off your bond for you. So in essence, using other people's money to build up your own wealth. Now, the downsides of residential property investments are, once all your properties are paid off and you want to start living off of your investments, you will eventually need to start paying tax on rental income. And this is taxed at the worst kind of tax, income tax. While you will never pay more than 80% capital gains tax or 20% dividend withholding tax on something such as, for example, share investments, income tax can go as high as 45%. There is no real tax flexibility with investment properties. Rental income is taxed as income. No way around that. With an investment portfolio in listed property, on the other hand, you can craft it to try and take advantage of many different tax exemptions, such as the 40,000 Rand a year capital gains tax exclusion and the annual 23,800 Rand interest exemption. You cannot put your investment properties inside a tax-free savings account or retirement annuity, and thus you cannot leverage these tax protection rapids to your advantage. A residential property investment is also a highly concentrated investment, as it is one instance of one asset in one sector, in one location, for one currency. If this is your only investment, then the lack of diversification is quite a big risk. And as you can imagine, property investment is often a hands-on type of investment, which means you will need to be involved in managing the block and tenants if you don't want to hire a managing agent. You will need money in reserves to cover unexpected expenses, such as a tenant that destroys your property, or if the property goes vacant for a couple of months. And property is not liquid at all. It often takes weeks and sometimes even months to sell a property, and therefore, if you urgently need money for something else, then you will probably get a much lower price than what you would have wanted if you need to sell it urgently. And as mentioned earlier, there goes a lot into choosing the right property, determining all the inputs, running the numbers, projecting the returns, compensating for unpredictable events, making an offer, and tracking your investments. Now, this is obviously too much to cover in this video, so instead I will link down to a really useful article from Stealthy Wealth that you can check out how all of this works if you are interested. Now, let's look at the other strategy that you can follow: listed property investments. Listed property companies are basically companies listed on the JSE, which own a variety of properties and then rent out the space. For example, your local shopping mall is more than likely owned by one of these companies, and they rent out shop space to all the different stores in the mall. These companies usually own properties over different sectors, such as industrial, commercial, retail, and residential properties, and may even own international properties as well. So instead of buying each one of these properties yourself, which will be hell of you expensive, you can simply invest in a share of one of these companies and thus essentially own a small part of each one of the properties owned by the company. And the best and easiest way to do this is to either buy yourself a property ETF or to buy a share in a real estate investment trust. The only real difference between these two is that a REIT actively manages a bunch of properties, while a property ETF tracks the performance of a bunch of property companies in a much more passive manner. So in essence, a property ETF will be much cheaper, but a REIT might have a better chance to outperform the market and thus give you slightly better returns. But in any case, if you invest in either of these, you get exposure to a large variety of companies, property sectors, and geographical locations, thereby adding much more diversification to your portfolio than just buying one property individually. Plus, it is so much easier to log into your brokerage platform and buying a property ETF than it is to buy physical property, as you don't have to worry about dealing with tenants, maintaining the property, and trying to maximize your return. And you need far less money to get started. So, in my non-financial advice opinion, Listed property investments is a lot less stressful and much more suited for the average beginner investor. And in addition to all of this, with listed property, you have much more tax flexibility to score on CGT and interest tax, as mentioned earlier. You can put your listed property investments in a tax-free savings account or RA wrapper, thereby saving more tax. And lastly, listed property investments are much more liquid. So if you do need money urgently, then you can simply sell off your investments and you will have enough money in your bank almost instantly. Now, I know what you want to ask. Peter, which one of these will offer me the best return? Now, there is no simple and straight answer to this, as it really depends on a lot of factors, especially your level of expertise as a property investor. But looking at some of the statistics, over the long term, the house price growth in South Africa has averaged just a little over inflation at about 0.6% per year. And based on an analysis from Stealthy Wealth, the estimated total real return, meaning after inflation, from residential investment properties will be around 6.9%. Now, comparing this with listed property in South Africa, the average growth over the past 20 years was just a little over 10% after inflation. And even taking into consideration the brokerage fee that you might be paying when invested in a property ETF, this will offer a far better return than residential investment properties. And if we look at the biggest listed property companies in the world, you might be shocked to see that their residential property exposure is very low and sometimes even zero. So if the best of the best see better value in commercial, industrial or retail property, then this probably means something, right? Maybe residential property investing is not all that it is made out to be. What do you think? Let me know down in the comments. Now, if you want to physically buy property, then you will need to go out and find one. Again, there is a lot of things to cover with this one. And seeing that I am by no means an expert in this field, I will link to a couple of blogs that you can check out that will help guide you down this process. For listed property investments, you will need to find a broker that will trade on your behalf on the JSE. You can then buy either property REITs such as Growth Point Properties, Vukule Property Fund or the Investec Property Fund, or ETFs such as the CoreShares Global Property or Satrex Property ETF. The easiest and cheapest platform that I've seen and am also currently using for property ETFs is called Easy Equities, which will basically allow you to buy ETFs at a very low brokerage fee with no annual admin or no platform fees. And if you want to check them out, then you can just click on the link down in the description to get started. Another option is to try out the new play in the game, Easy Properties. This is a platform that is part of Easy Equities that operates by means of fractional property investing, which basically allow people to invest in real property in the same way that the share market allows them to invest in listed companies. This allows first home buyers to get exposure to property much earlier in their quest to own a home, and the entire process is basically streamlined through a tech-friendly online investment platform. They take care of all the hassles of managing a property while you sit back and earn your share of rental income and capital growth. This also allows those who do not really have enough money to put down a deposit to buy a house to invest in physical property, as there is no minimum investment amount required, therefore making this type of investment much more accessible to everyone who wants to give it a go. Now, I'm sure that you've seen by now that I favor investing in listed property above investing in residential property. And my reasoning behind this is it has been proven to be more profitable in the long run, The barrier of entry is much smaller, as you can basically start with any amount of money. It is much easier as the learning curve for ETF investing is much lower, and because I simply like to keep things simple. I'm a vet, not a real estate agent. I do not want the stress of chasing after tenants and repairing buildings, as I physically do not have the time for that. But that is just me and my opinion. If you think that you have what it takes to invest in physical property, then go for it. Just make sure that you know what you are doing, as your level of success will be directly correlated with your level of skill and knowledge, both of which can definitely be learned and practiced over time. And regardless of which one you choose, remember that with both of these, you will need to maintain a long-term view on your investments, at least for around about 5 years and more. Also, since the return from property investments in the form of rental income is much more reliable over time than shares from other companies, it makes listed property shares much less risky than other equities and makes them a great diversifier. So they should therefore definitely form part of your overall investment strategy, together with shares, bonds and cash, to offer a well-structured diversification to your portfolio. So let me know down in the comments which team you are playing for. Would you like to get your hands dirty with investing in physical property yourself, or do you like to keep things simple and rather invest in REITs and listed property ETFs? Thanks for watching, guys. If you found this video to be helpful, then please remember to leave a like and share it with your friends. If you want to learn more about other types of investments such as shares, bonds and cash, then make sure to check out my playlist over here on the Investing for Beginners in South Africa series. And if you are new to my channel, welcome, and consider subscribing so that you don't miss out on any future videos. Anyways, guys, that is all for today. Thank you for watching, and as always, have a lekker day, and I'll see you in another video next week. Cheers.